8:44, 60 moving after 8 o'clock. Welcome back to Good Morning TNT. In this segment, we have our friends who are with us every fortnight from the Unit Trust Corporation. Today, we're focusing on the value of investors understanding risk versus return. Our guests are back with us, Phillip Williams, who is a manager research investment, research portfolio management. Good morning, Phillip. And also, for the first time, Zikomo, Townsend, macro analyst, investment with the Unit Trust Corporation. All right, so we're talking about risk versus return, which means there's several different profiles of investors that will be considering. Let's just define risk and return in their relationship. Sure,
no problem. Before we get on to matters of business, Paul, let me just say thank you very much for having us here.
You're welcome.
When the corporation has the opportunity to share, we count it a privilege. So thanks for having us. Thinking about risk and the investor, just simply put, what risk is the uncertainty of an outcome. So in financial terms, right, or investing terms, you may have the expectation of an outcome, but there's the risk, right, that you may not achieve this outcome, right? But what's important, I think a salient point for an investor to know, risk and performance is inseparable. With every investment, there is an inherent risk, but it would be remiss of me to say, or not to say, right, at the Unit Trust Corporation, we are here to manage that risk on your behalf, right?
What should determine, Zico, one's risk appetite or one's delving into how much risk you should absorb at any point in your career?
That's an excellent question. It will certainly depend on your goals in life. So let's say you're younger, you have your whole life ahead of you, maybe you just graduated from school. At that point, you'll want to have aggressive risk or aggressive goals, slightly more aggressive goals. Maybe you want to buy a house in 15 years, you want to have a fancy car, you know, you want to plan for a family. You have a longer time to make up for your investment, so you want to invest in more stock or equity funds. In that regard, we have the Growth and Income Fund, Universal Retirement Fund, the North American Fund. Now, as you become a little more seasoned, you stop thinking about the aggressive goals. Maybe you are about 6 to 10 years away from retirement. You want to make sure your money is stable. You want to make sure you're getting a steady income. You want to make sure your capital is safe.
So you can't afford risks that many risks.
That's correct. So you would shift your portfolio from the more stock-based things to the more fixed income assets, the more bond fund assets. In that regard, we have the US dollar income fund and the $30 income fund to serve your needs.
Phillip, let's also go through, even within the early ages, when you have more paychecks, because I know you're always counted in terms of paychecks and ability to bounce back.
You're speaking it.
How much should we balance, though, your portfolio in terms of, one of the bits of advice from the Unit Trust is always don't invest everything in one area or one stock. So you have a kind of balanced approach to investment.
And you're speaking balance, I mean, that what you're really speaking to is diversification, and all that really means is spreading your risk over a series of investments. And when you invest, Zico quite rightly said, he mentioned the Growth and Income Fund as a product, and it's more of an aggressive type product for a younger person. This is not just to say only a young person can invest, but you would want to be putting more, allocating more to that type of product because of the type of risk attached there. But certainly you want to spread your risk, as I'm saying, because we know that the globe is coming out of a financial crisis. So just let's say, for example, we know that some companies are no longer with us today. So in the event of you placing all your assets, all your money into one investment, you actually stand the risk of losing versus spreading it over a series of investments, which is what we do.
You can buffer.
Certainly, because it's highly unlikely that 100% of the assets are not going to perform or actually going to go under. And this is what we do at the Trinidad and Tobago Unit Trust Corporation. People, what you need to know is when you make an investment, you have to have the time to monitor it. You have to have the skill sets to understand how to read financial statements. And if you don't do that, what you do is actually rely on the people that can do that for you. And this is what we do on your behalf.
And with that said, how much emphasis should we, as the novices compared to you who are trained, pay to attention to what are the low-hanging fruit and what people look at? The Apple stocks, the Samsung stocks, which are the international stocks that people gravitate to, and even the local ones like the IPOs that may come about, and how are they absorbed in your schemes of the Unit Trust in terms of that diversified portfolio, where people say, well, I hear this is a big yield, the more popular ones, but then there may be something coming into the market that may be not as popular, but maybe showing potential from where you sit as a professional, Ziko.
Well, it's very important for everyone, regardless of your stage of investment experience, to do the research necessary to make an investment. So you don't want to be buying into a product you're not sure.
But what should drive that research? Because you could go on the internet and a million different things are coming at you, and none of them are valid because you don't have the experience of the trading to decipher what is scrap from what is legitimate or sustainable.
But once again, I want to tie it into your goals. I mean, if your goal is to have, you want to take on a lot of risk to supposedly get a higher return, then obviously you want to pay attention to the stock market on a whole, the local and the foreign stock markets. You want to pay attention to political risks in other countries because these things affect the stock markets, you know. But if your main concern is preservation of capital, you're satisfied with maybe a lower rate of return, then definitely you could, you know, take a little less risk off the table. You invest in a little more stable assets that you don't have to really monitor on a day-to-day basis, even though everyone should be reading and doing their research regularly. That's correct.
Don't leave it to you alone.
Always read that. Don't leave it to me alone.
Phillip, what are some of the major misconceptions people have about investment when it comes to risks and rewards? Do the get-rich schemes ever really work?
No, actually, if it's too good to be true, probably it's, you know, more than likely it's not true. But the misconception is, you know, you have to be wealthy. You know, and this is actually where the Trinidad and Tobago Unit Trust Corporation has changed.
So you don't have to make
no. You with $100, or if you have $100 or $100,000, you walk into our doors and we are here for you. So it's a typical misconception. People wait on that big windfall. So, well, I'm going to wait to see when I, you know, accumulate this amount of cash. And actually, if you understand time and the value of money, we work hard for money. So if you take your dollar and you put it down to work for you, the sooner you do that, the better, because it has more time to work for you. You have a big, you know, greater potential to earn as you go along. So time and the value of money, that's one misconception. A lot of times people make an investment and they say, well, you know what, I saw this on TV, a friend told me this, you know, and Ziko was very correct. You know, if you are, let's just say you're looking at a company, that's very simple. You know, you mentioned Apple. Well, everybody's clamoring for the Apple phone. You know, in pre-sales were like in excess of 4 million. So that should tell you something about the product. You know, the product is not even out yet. So that tells you something of the company. Certainly you're looking for strength of the balance sheet.
But what about when you see little dips in the stock value of the company, like we saw? Yeah. With Apple, with the glitch in their cloud security systems. Should that panic you in any way, or are those things sustainable?
It is certainly something that you pay attention to. But what you do know, if you understand the fundamentals, which is what we do, a lot of fundamental research, you understand, you can have the assurance, well, you know what, today, you know, okay, there's a drop, but certainly, you know, more than likely, once you have the time, which is, you know, Apple may be viewed as an aggressive type investment because it is equity. Once you understand the fundamentals, you believe in the management, because what you're saying when you purchase a stock, or what the corporation says, the Trinidad and Tobago Unit Trust Corporation, when we invest in a stock, we say we believe in the management. It's actually management we're buying. We believe in the principles of the corporation and that they're going to be around for 100 years.
The history of the company.
The history of the so you don't. So a drop actually can be a good thing, and that's a way to mitigate risk, because actually that's the time you want to purchase. A misconception: people buy high. You know, when you actually should be.
When the dip in a sustainable company like Apple,
buying low.
Is when you should dive. You can dive in.
That's correct.
All right, Ziko, let's talk about, I mean, this is like reverse engineering, but for the general public, the differences between equity, stocks, that sort of stuff. So we have a clear understanding of what we are faced with when the options are presented to us.
So just to define quickly, stock or equity is simply a share of ownership in a company. When you buy a stock, you're actually buying into the ownership of the company. You're actually buying into the management, the business line, the products. You know, you're buying into the performance of the company. And as a result, the stock price is actually going to reflect how that company performs. A bond is just a fancy term for a loan. It's an agreement to repay between two parties, a lender and a borrower. So in that regard, when you buy into a bond, you're buying into a company or someone's or a sovereign, Trinidad and Tobago government, for example. You're buying into their ability to repay the loan and interest and coupon as will be.
And what are the various options in terms of the portfolios where you see equity, stock or bonds are dispersed throughout the instruments of the UTC?
Well, all right, so we have, earlier Ziko would have mentioned the Growth and Income Fund, which actually is a balanced fund. The Growth and Income Fund, the majority of that fund...
What does that mean, it's a balanced fund?
A balanced fund is, good question, Paul, that there's both equity and their bonds inside the portfolio. So it gives a balanced approach. Actually, there's a means to diversify as well. So if equity is not performing as well, then therefore the bonds are not going to perform as well. If bonds are not performing as well, the equity is also more of a balanced approach, right? And we're talking diversification. Somebody might say, well, we're only talking Trinidad and Tobago. What's important to notice in the Growth and Income Fund, as well as our Universal Retirement Fund, whilst these funds are, the majority are local stocks on the best companies on our local stock exchange, there's also an international component, and where, the professionals, we would look to see where there is value around the globe to position the fund so that, the unit holders can get the best return. So a balanced fund, very simply, has equity and it has debt. The fixed income products that we have, which are the TT Dollar Income Fund and the US Dollar Income Fund, they're fixed income instruments which are very short term, and they're bonds. So there is a balance there, but it's strictly fixed income products in those type of funds.
Zico, how flexible are investments in any of the schemes in terms of the instruments applied? I know some are short term, some are medium term, some are long term, but there's some, in some instances, built-in allowances for access to. With some penalties in some instances, I understand, but explain some of those to us so we know what the options are.
So we know that the US Dollar Income Fund and the TT Dollar Income Fund are the income products. They actually have assigned to them debit cards, so you are able to go and take out your money at a moment's notice. They are more of a savings account type product, but they are not a savings account. It's actually an investment. In terms of the Growth and Income Fund and the North American Fund, the Universal Retirement Fund, you would have as much access to them, but you have to come in and sit down with us, and we will guide you after that. So if you want the ease of money, you want to transfer money easily, you want to take your money easily out, the US Dollar Income Fund and the TT Dollar Income Fund is what you would use.
And in terms of the risk appetite, once again, the younger investors generally the one with you would advise to be a little more aggressive or adventurous in terms of the risk appetite. What about the person who may come into some sort of lump sum? We get the back pay syndrome in Trinidad and Tobago, and it may not be sustainable. It's certainly a lump sum that you expect like every 5 years, every 7 years. But how would you advise someone to deal with those sorts of opportunities in terms of investment to bolster your portfolio?
Whilst that's somewhat of an outlying moment, not everybody gets that big windfall, and I know I said earlier, you don't wait on that, but if it does in fact happen, you apply the same principles. Now, Zico spoke about this stage of life where you're at, so you're shifting from aggressive and again becoming conservative, and then actually just probably shifting mainly into fixed income. What you want to do is just look at that lump sum and just say, for example, if I had $1, if I was a younger person, I might put 80% into an equity type product because I can be aggressive, and put 20% or 20 cents of that dollar in a fixed income product. It depends on the stage of life where you are at, and that's where you basically shift. But you want to definitely diversify and have a spread. You don't want to be too aggressive.
Don't put your eggs in one basket.
Don't put your eggs in one basket.
All right.
No.
And more information can be had at TTUTC.
That's correct, and you can reach us at 6258648.
And you get all this on advice. Thank you, Phillip Williams.
Thank you so much.
And Zikomo Townsend.
Thank you.
Both of the Unit Trust Corporation. As we head up to 8 o'clock, we are going to connect now via the telephone to Dr. Keith Clifford, who has our very popular House Call show on at 9 this evening. Good evening. Good morning, Dr. Clifford.
Good morning, sir. How are you today?
I am fine, thank you. So how are you?
I'm feeling good. I'm glad to be awake on this wonderful Tuesday morning.
Always waxing poetic, are you? What can we look forward to this evening at 9 o'clock on House Call?
This evening we're talking to a consultant neurosurgeon who's originally out of Austria.